Wouldn't it be great if you were able to get paid while waiting for the stock price to come down to your level or for the stock price to drop? So even if the stock went sideways, you still got paid? Well, that's exactly what I'm going to do in the next few minutes in this video. Is I'm going to show you how you can make an options premium income by waiting for the stock price to come down to the level you want. And if the stock continues to get higher, you still get paid. Now, the way we're going to do this is we're going to sell a cash secured put against a certain ticker or stock in this case. Now, if you don't know me, I'm Sasha, the options coach, and I've been teaching people to trade options over the last 10 years. So let's get started with our example. We're going to take a look at this diagram here for the stock price moving higher. Now, if stock prices are moving higher, what a lot of people do is say, oh man, I missed a move. And then they try to get into this position only to later see it fall back down. And what we want to do in order to capitalize on this is we want to say, well, look, if the current price right now is at $80 a share, you might say, well, if it gets back down to 70, I will take that stock. 70 or lower, I will buy that stock. But if it doesn't get there, somebody's going to pay me some premium or income. Now that will depend on how many days out you go, what strike price or how close you go. Like for example, if you get to 75, you might get paid more versus 70, you might get paid less because it's a little closer to the current price. But let's say we get paid $120 for waiting for that stock price to come down to our level. And it may not come down to that level. It may not come down to 70. If it doesn't get down to 70 or lower, we still get $120. And if it stays higher or above 70, I still get the $120. The only difference is that if it comes down to 70, I have to take those shares. In other words, people are paying me in order to wait and protect their stock that I'm willing to take it off their hands at 70. And that's what you're doing by selling a put against that stock. You're willing to take that stock at a certain price within a certain date and time. And if it stands still, you get paid. If it keeps going up and higher, you still get paid, which means you're not really missing out on the move. And if it pulls back, you get the stock at a much cheaper or discounted value. Now, you can do this on all kinds of different stocks and positions. For example, right now, currently, if we look at a chart of IBM, and you can see this stock continues to kind of ramp up and go higher, you might say, look, I don't want to buy the stock at the highs. And if you don't want to do that, what you can do is sell a cash secured put against it. Now, I might go 25 days out in this case for this example. So if we go 25 days, we put an IBM and we go to the November 8th in this case, and I might say, okay, I'm going to sell a put against it. Current price is 234, almost 235. And I might say, I'll take that stock at 220 or 225. So if it pulls back, I will take it at the price that I determine, but I get paid a certain amount of value, in this case, $445, if I take it at 225, to wait for that position to come to my price level. So by selling one option contract, I'm willing to take 100 shares because one contract controls 100 shares at the 225, even though the stock price is at 235. So that's $10 cheaper that I'm willing to take it. But if it stays above there, I still get the $445. Now, by sending that in, you'll see there's the $445 that I'll be able to take, and we can send that position in. And once you evaluate this position from a risk analysis, you'll be able to see that, hey, I'm willing to take that position at 225. But if not, I get to make that premium of $455. And that's really the way that it works, is that if that stock stands still or goes up or even pulls back slightly, I still make the $455. However, if it gets down to 225 or below, then I have to take those shares, but I still make the $455. And it's a nice way to generate some income from your positions, waiting for that stock price to pull back, especially when you have something like this, where the stock continues to power higher or keeps moving up and you're not seeing any pullbacks. It's also not a bad way if the stock keeps heading lower. You might say, well, I'll try and buy it even at a lower price. But anyways, use this tip, use this insight to be able to gain some additional income from selling cash secured puts on your positions and trying to acquire stocks at a lower level. So I hope this helps. If you have any questions, do please reach out. I'd be happy to help.